In this video, traders, we're going to look at not all support and resistance is equal, how we can grade our key levels for optimum performance. Stay tuned. Hey traders, a very warm welcome to you. So, you've got your chart up. You've got your support levels, your resistance levels, your key levels. You've got a multitude of lines there and you're going, hey, you know what? How do I trade that? They're all relevant. They're all relative. They're all relevant, should I say. They've all got general reasons for being there, not just drawing lines for the sake of it, but some are going to be bigger than others. So the idea of this theory of grading your key levels is that you can give a key level more weight. So if a key level has a lot of weight, i.e. hey, that's a really solid key level, it's a grade 1 or grade A, however you grade it, it means that you might look to initiate a counter trend trade there. You might look to take profits from your trade there. It's something that you probably want to do business at as a trader. You want to look at price action, you want to set up strategies, etc. However, if you've got, let's say, a grade 3 level, which is a reasonably valid level, you're not going to want to initiate a trade at it, but it might be a level that you want to watch to see how price performs, that maybe something comes from it, but not necessarily initiating something immediately. Perhaps the price is running up to it and you're in a long trade and it comes up to a minus resistance level and you're like, okay, I'm not going to close the trade here, but I'm going to watch how it behaves. That kind of thing. So how would you do it? And this really allows you to have much more of a clear vision on what you're doing with your trading. It allows you to really focus on the things that matter. It allows you to eliminate some of that noise and then just be looking at the right things while still having the levels on. Because of course the dilemma is, well, you know, if I just put really big levels on, I'm missing out on the little levels that actually could be good for me, but I still want to know that I don't want to clutter up my chart. So you've got this thing. So this is a kind of good compromise and a good solution for that. So this example here, right, we've just got a kind of random chart, so to speak, and we can draw on some key levels. Now the obvious big level, which would stand up to most of us here if we're seasoned traders, is going to be this one here. Yeah, we've got a really big key level here where price is tagged 1, 2, 3, 4 times. That's going to be a kind of grade 1 level. It's going to be one that you really want on your chart and you know you want to do business at that level, right? You know that this is kind of the foundation of this day or this week or this month, whatever. It's the foundation of this chart. This chart revolves around that. In other words, hey, if you're bullish, you might look for a buy through, a breakthrough. If you're bearish, you might look to fade it. I'm not going to go into the reasons why you would do either of those now, but the point is that is a really interesting level that people are watching, right? Another one you would want to have on your chart would be this here. Okay, we've got a key level and actually running through, you can see that's probably an extra little bar here to make it right. That is a reasonable level. Okay, it's not a massive level. The price has gone through it multiple times. You know, it's gone through it early on in the trade. It went through it again there, went through it again. It's gone through it a lot. So it's not as prevalent as number 1. It's not as important as number 1, but it's still pretty decent. We won't grade that yet. And then we've got some other minor ones on there, right? We've got this little low here, which is reasonable. And then we've got kind of a little one here where we had a short-term high and it also found some support at that level. So you can see different levels on our chart, different characteristics of each. The obvious being that big one. Second one is probably here. And how would we grade that? Would that be a level 1? No, it wouldn't be, because price has already been through it several times. Price has not been through that. That is the most strongest level ever, and one we're looking to do business at. We'd probably grade this one a grade 2, right? It's somewhere where actually, you know what, as we pulled down here, if it pulls back to it, I might want to initiate a short after I've seen some weakness. I might want to see a few more things first before I take it. Perhaps if I'm looking for my long, I want to wait until I see that hold if I want to try a breakout. You know, there's little things that you might want to trade. You probably won't want to do that anyway because that's such a big level, but you get the idea. And these here, these two here, are going to be kind of grade 4 levels, aren't they? Or grade 3 or 4 levels, depending on how you're going to grade it, because they're really of no interest to anybody. This could be a little bit more interesting because it's only been broken through once. That one, however, is a nothing. It's a real intermediate nothing level. You're not going to initiate a trade there, especially not when you've got bigger levels nearby. So this allows you to eliminate a lot of noise, guys. You've got charts, you've got so much stuff on your screen, and it does prudent to have have those levels there, because let's say you are, long from down here and price starts to push back up. You want to still be aware that that was the prior low swing and it might be a reasonable level. And as price starts to push back up, perhaps you want to scale out of the position there. Perhaps you want to see how it performs. Perhaps in your, price targets or reasons to close the trade, you are looking at that and saying, well, you know what, if it starts to stagnate there, I'm going to come out of the position, etc. However, your full target might well be at number one. You're not even going to look for any more than that. It's such a huge, big level that you're not going to even try for the breakout. You're going to look for the mean reversion back to it, and that's going to be your final exit. So grading your key levels is a simple way of really giving yourself clarity, not giving yourself too much noise, and allowing yourself to adjust the trading plan around what's the most important out there without neglecting some of the little smaller levels which still come into play, but just on a smaller scale. They just come into play later on, or they need a few more bits and pieces to be more important. So try that, guys. Grading it, whether you grade it A to B, or A, B, C, or D, or whether you grade it 1, 2, 3, doesn't really matter. The point is having that grading system and then implementing that into your trading plan. All right, guys, hope that's helped. See you in the next one. Take care. Bye-bye.